Hello, hi friends, welcome back to my channel Ritika Durgapal. Here I am with the next topic, that is how to compute the income from house property. Today we are going to study it in detail. Let us first begin with the applicability. Property should be any land or building appurtenant thereto. Land appurtenant means land connected with building like garden, garages, etc. Now, building not only include residential building, but it also include factory building, office premises, other commercial premises, etc. If assessee is engaged in the business of letting out of the house property, or he is using the house property for his own business purpose, then such income from such property will not be taxable under the head income from house property, but it will be taxable under the head income from business and professions. Now let us discuss who should be the assessee. Assessee should be the owner of house property. He should be the owner during current year. It is immaterial whether he is the owner for the assessment year or not. Ownership include deemed ownership also. Now, property can be classified in three, that is, let out property, deemed to be let out property, self occupied property. Let out property means a property which is given on rent. Self occupied property means where we are staying along with the family. And now, deemed to be let out property is the one which is not given on the rent. Only one house property can be treated as self occupied property, and if it is not let out second property, then it will be deemed to be a let out property. There are certain amendment on this topic for the financial year 1920. Please check my Union Budget Update 2019. Now let us discuss the chart of computation of income from house property. Let us discuss the whole chart first, and then each term separately we will discuss in detail. Now I had made a chart that is particular. LOP means let out property, DLOP is deemed to be let out property, SOP is self occupied property. As in case SOP, all the amounts will be nil, only the deduction under section 24, that is interest on loan borrowed, will be allowed. Under the head DLOP, actual rent is nil, as because we are not receiving any actual rent, it is deemed to be let out property. So your expected rent will be the gross annual value. Now let us discuss the statement, that is municipal value or fair rent, whichever is higher will be compared with the standard rent, whichever is lower will be your expected rent. It is compared with the actual rent and you will arrive at gross annual value. Now from gross annual value, municipal tax paid will be deducted and you will arrive at net annual value. From this, deduction under section 24 will be allowed. First, that is a standard deduction of 30% of NAV means this is a flat deduction, no expenses deduction will be allowed. This is a deduction for expenses. And interest on loan, there are certain conditions that we'll discuss later on. After deducting this too, you will arrive at income from house property. Now first, what is municipal value? Municipal value is the value of house property determined by local authority. Second, fair rent. Fair rent is a rent of house property in same area with same facility and everything is same. Standard rent, rent as per Rent Control Act. Next is expected rent. Expected rent has been calculated as municipal value or fair rent, whichever is higher. It is compared with the standard rent, whichever is lower will be your expected rent. Expected rent is nothing but the minimum rent of your house property should be. Now, what is actual rent? Actual rent is rent actual received or receivable. It is calculated as actual rent received plus receivable minus any unrealized rent. Next is gross annual value. Gross annual value will be calculated as higher of expected rent and actual rent. Let us discuss the GAV in detail. GAV will be actual rent plus rent receivable plus vacant rent minus unrealized rent, and this will be compared with the expected rent. Whichever is higher will be your gross annual value. AR is denoted as actual rent received, RR is rent receivable, VR is vacant rent, UR is unrealized rent. Now if this actual rent received plus vacant rent minus unrealized rent is more than expected rent, then actual rent will be your GAV. But if this is less than expected rent, then ER will be your GAV. Vacant rent is not a part of GAV while calculating the value of AR. Now, what is unrealized rent? Unrealized rent is a rent which is not recoverable. It will be excluded from your actual rent received and receivable because it is irrecoverable. Municipal tax. Municipal tax, it should be borne by the owner, means its owner should actually pay the municipal tax. It should be actually paid during PY, means during current year it should be paid. Deduction is allowed for municipal tax on payment basis and not on due basis, means if you paid then you will be allowed as deduction. If municipal tax paid for current year and next year, then deduction will be allowed in next year and not in the current year. If municipal tax is given as percentage, then it will be calculated on municipal value. Gross annual value minus municipal tax will give you net annual value. Now let us discuss the deduction under section 24. Flat 30% standard deduction of NAV. Flat deduction means what? You will be not allowed any expenses incurred on such house property. A flat deduction for an expense of 30% will be allowed. Second, interest on borrowed capital. Interest payable on loan borrowed for the purpose of acquisition, repair, renewal, reconstruction can be claimed as deduction subject to certain conditions. Interest for pre-construction period means can be claimed deduction over a period of 5 years in 5 equal annual installment commencing from the year in which the construction is completed subject to maximum limit, means the interest you had paid during the construction period can be claimed after you had completed your construction in 5 equal annual installments commencing from the year in which the construction is completed. Now, deduction allowed from NAV can be divided in two parts, that is LOP, DLOP, that is let out property and deemed to be let out property. Second, self occupied property. Now, let us first discuss the let out property and deemed to be let out property. From this, a standard deduction of 30% will be allowed from NAV of NAV. Second, interest on borrowed capital. Now, in case of LOP and DLOP, interest on borrowed capital is fully allowed. Like there is no maximum limit for LOP and DLOP to allow the deduction for interest on borrowed capital, and it will be allowed on due basis. Like in the year in which it is due, you can claim the deduction for interest paid on borrowed capital without any limit to the amount of deduction. Now, secondly, let us discuss regarding self-occupied property. Now, in case of self-occupied property, similarly, it is divided in two. That is, standard deduction will be nil because here NAV is nil. Interest on borrowed capitals are divided in two parts. First, where the loan is taken for repair, renewal, or reconstruction of the house property, maximum rupees 30,000 will be allowed as deduction on interest on borrowed capital if it is for the purpose of repair, renewal, or reconstruction. Where the loan is taken for acquisition or construction of house property, then there is a two part. If the loan is taken before 1499, then maximum 30,000 will be allowed if the loan was taken before 1499. But if the loan is taken after 1499, then there are certain conditions. If you satisfy that condition, then maximum rupees 2 lakh can be claimed as interest on borrowed capital. If not satisfied, then maximum rupees 30,000 you can claim as deduction. There are certain amendments to this. You can check my Union Budget Update 2019 for your amendment purpose for financial year 1920. Now let us discuss the conditions. The loan should be taken after 1499. Second, construction or such acquisition is completed within 5 years from the end of the year in which the capital was borrowed. Third, certificate to be furnished from the person whom the interest is payable. Next, important points for deduction, that is, the limit is not applicable to LOP and DLOP. Second, interest is allowable on due basis and not on payment basis like municipal taxes, means the deduction will be allowed as it is due. Unpaid purchase price would be considered as capital borrowed. Interest or penalty on unpaid interest is not allowed as deduction. Means if you had not paid interest for a particular month or year and it has charged, penalty or interest will not be allowed as deduction. Deduction will be amount due or maximum limit, whichever is less. Now, what is arrears of rent? Arrears of rents or unrealized rent, if subsequently received by the tenant, then it will be deemed to be the income from house property. Only deduction of 30% will be allowed and balance will be taxable as income from house property. Arrears of rent or unrealized rent will be taxable even if the assessee is not the owner for a particular year when it is received. Now, what is co-owner property? Co-owner property, if it is a self-occupied property, the net annual value will be nil for each owner. Plus, each owner will be entitled to deduction of maximum 30,000 or 2 lakh as the case may be on account of interest on borrowed capital. Similarly, if the co-owner of the let out property, then income of such house property will be calculated as if there is a single owner, and then computed income shall be divided between the co-owner depending upon the shares in property. I hope video was useful to you and easy to understand. Please do solve the sums on the above topic, and if you have any query, please ask me in the comment section. Thanks for watching guys, and please don't forget to like, subscribe and share